In this section, we're going to talk about monetary policy. And remember, monetary policy is the changing either the money supply or interest rates to impact the macroeconomy. And the macroeconomy, when we say that, what we're really talking about here is we are talking about inflation and unemployment. Okay, so monetary policy is typically aimed at one of those two things, and it has very little to do with long-run economic growth. It's mostly focused on these short-run aspects. One of the things we're going to see in just a second, the interest rates, the monetary bias will influence them. It's not a direct setting of them, but it will influence them. So as we've seen already, we have three traditional monetary policy tools. I'll just say tools since we're already talking about monetary policy. So three traditional tools, okay, for monetary policy. And this is basically pre-2008. Since 2008, you'll see a later video that discusses the things since then. So we have open market operations, and then we also have changing the reserve requirements, and finally we have changing the discount rate. So in this first video, we're going to just talk about the open market operations. Okay, so we're focusing on the first one, and this first one is the most important one. So this is the most, I guess you can say, most commonly used one. So we're going to focus a lot on this. The other two we're just going to touch on really, really lightly. Okay, so let's start with open market operations. So we can just for short call this OMOs. So open market operations is the most used. And what is it? So this is the buying, selling, short-term T-bills to influence bank reserves and interest rates. Okay, so they use these short-term assets, and then the central bank buys them or sells them, and this influences the bank reserves and also the interest rates. Okay, so for the Fed, who does this? Well, it's the Fed Open Market Committee, so FOMC. You can take a look in your text. So this is 7 board members plus 5 other voting members. Okay, and these are drawn from the regional banks. So this committee makes a decision about the target for the interest rate. Okay, and remember the interest rate that, as I mentioned in the part that wrote, the interest rate they're targeting is the federal funds rate. So they want to lower interest rates. So here's how it's going to work. So let's suppose the FOMC wants to lower the interest rate. Okay, so what they do is basically, well, they first start by they set a lower target. Okay, so they're targeting this rate. Say that it set a lower target for the federal funds rate. Okay, that's the federal funds rate. And so how do they do this? So first thing they do, the Fed is going to buy T-bills, these short-term government bonds. These are short-term bonds of 1 year or less. Okay, they buy the T-bills. Now, who do they buy them from? Well, they buy them from the banks, right? So then the banks are selling the T-bills. So they had these on their balance sheet as assets before. They sell the T-bills. Okay, so now what happens? Well, the T-bill goes to the bank, and the Fed gives them money, right? So when the money is still inside the bank, we call it reserves. So the banks gain reserves. So they have more reserves. And then the next step, as we'll see, doesn't. And we hope it happens. We'll find out that it doesn't always happen. But anyways, the banks make loans. Okay, so the banks make loans, and this more loans does two things. Well, then they're also multiplied, right? Because remember this process of multiplication, where people take a loan and they make a payment, and people receive those funds and they deposit in another bank, right? So with this fractional reserve system, we have some multiplication going on. So we can also say these are multiplied. So these initial reserves are multiplied. So we get loans, and then we end up with more loans. And in the end, we get, well, more deposits, right? And that means more money supply. But the other thing that we have here is we have more loans, and we're going to get lower interest rates, right? So you can say, well, the supply of loans have increased, right? If this is a market for making loans, this last one, so if this is, and this is the interest rate, sometimes we use R here, so this is the demand for the loans, and now because more banks having more reserves, the banks can make more loans, so now then this interest rate, actually I'm going to change this to I just to make it simple. So this interest rate then will fall, right? So the interest rate is falling. So we end up with more loans. The more loans can be seen on the horizontal axis, and we're also seeing with lower interest rate. So this is the idea. So by doing this, the Fed can then buy T-bills, and banks gain reserves, more loans, lower interest rate. Okay, so this is a basic idea. We'll come back. I'm going to come back in a second video and walk through this the same way that they do in your textbook. The opposite of this is also true. Okay, so the opposite is also true. If they wanted to, if the Fed wants to raise the interest rate, okay, so let's suppose the Fed wants to raise the interest rate, okay, because, and we'll talk in a second why they want to do that, okay, they'll come back in the next video and talk about why they want to do that. So they're going to, in this case now, they're going to do the opposite. They're going to sell T-bills. So the Fed is going to sell T-bills. So who do they sell them to? Well, they sell them to the bank. So now the banks buy the T-bills from the Fed. Okay, these when I say they're selling these T-bills, they're not actually the Fed is not actually the issuer of these T-bills. The Treasury Department is the issuer of the T-bills. The Fed just has them. They have some that they bought in the past or that they bought recently, and so they're going to sell them, right? So when they do that, the banks lose reserves because the banks have to pay for these, and they pay for them with their reserves. So the banks lose reserves. Okay. And when they lose reserves, they must reduce their lending and make less loans. And less loans means less deposits, less money supply. And it also means we got less supply of loans. So we get a higher interest rate. Okay. So if we go to the loans market, again, just to remind you of that, oops. If we're talking in this loans market where this is interest rate and this is the total amount of loans, then this losing the reserves, because instead they're buying these T-bills from the Fed, is going to raise up these interest rates, right? And it's going to slow down the lending process. Okay, so we can see we end up with a higher interest rate. All right, in the next video I'll come back and do this using the balance sheet of the bank.